Dan Mychok here with Waterway Wealth Management. Excited to have Leash Yu, formerly of Agency U, now Higginbotham, joining us today. Welcome.
Thank you for having me. It's good to be here.
Thanks for making the drive up from Houston.
Yep.
Appreciate you driving, and excited to talk to you about everyone's favorite subject in the entire world, insurance. But before we get into that, got to go and tell about our backstory here. So Leash was the first person I met at Texas A&M back 1988 at Fish Camp. First guy I ran into. So we've known each other, what would that be, 30, 36, almost 37 years ago.
Yeah, it's crazy.
Isn't that hard to believe?
You don't look any older.
You don't either. and you don't look any taller either.
Same height. Might have shrunk a little bit, actually.
But Leash has been featured. You might have seen him on Channel 2 News. Amy Davis recently interviewed him on homeowners insurance and rates. And so we're going to talk a little bit about that. But before we get into insurance, maybe take us back a little bit on your career, how long you've been in the industry, and maybe what you've seen.
I've been in the insurance business since 2002. And I was started as an exclusive nationwide insurance agency. And I don't know if you remember in 2002, the insurance industry was in quite a bit of turmoil because farmers just lost this huge class action mold lawsuit. And because of that lawsuit, just about every carrier in the state of Texas left because they couldn't make any money. But Nationwide hung in there barely, and we were able to really gain a lot of business because there was not a whole lot of stuff going on from an insurance perspective world now. So, and in about 2015, we went fully independent from Nationwide, became a independent agency under a group called Essential. And just recently in 2023, Essential was acquired by a group out of Fort Worth called Higginbotham. Higginbotham is a top 10, top 20 insurance agency in the nation now. So there's a lot of power behind what we're doing. And it's just been a good, fun ride. Yeah. So 23 years now in the insurance business, seen a lot, done a lot. So
come a long way from that office in the strip center on 290 and Mangum.
Yes, we I can't really tell you what we called that, but it was. But yes, it's come a long way. Now we've moved from 290 and Mangum, and we've been in the downtown West University, right in the middle of everything since 2006. So we're still there, hanging on. We don't know what the future holds as far as our location. I think Higginbotham is going to try to consolidate us into a bigger office, but that Westview office has served us right.
Yeah, you've been there almost 20 years.
Yeah, it's been nice. Yeah. Been really nice there. So
yeah. So I think about insurance today, almost similar to what was happening back in 2002. A lot of changes over the last few years. Maybe kind of give us a current landscape of what you're seeing on the homeowner side with, most recently some of the floods, the 2021 freeze, and then some of the hurricanes. What are you seeing right now as far as what insurance companies are here, what have left? What do you see right now in the landscape?
Yes. So back in 2002, it was a hard market, very hard market that we jumped into, but there were still markets that were open and people were still selling insurance and able to get insurance relatively inexpensively. This environment that we're in right now, it's the hardest insurance environment that we've experienced, that I've experienced in my 23 years, and really, maybe in the history of insurance. But it has everything to do with what they call these catastrophic claims that are occurring. Winter Storm Uri was a good example of a catastrophic claim, but a catastrophic claim, just to kind of give you some background, is any claims event that is $1 billion in property damage or higher. Okay. Right. And that Winter Storm Uri that happened in 2021 was the largest recorded insurance claims event in history. Wow. And so they were, I think there still might be calculating, but it was over $100 billion at the time.
Wow.
These LA wildfires that just occurred, the latest numbers I saw were that was going to be about a $250 billion event. So that will dwarf Uri if the numbers kind of stay constant. But These catastrophic events in the 2020s, I should say, they've been at record levels. And so in 2023, the annual amount of catastrophic events has been in the $75 billion range. The entire decade before, it was half that, $36 billion or so. And so these catastrophic events just kind of have a domino effect on the insurance industry because carriers just try to stay relevant. They try to not lose their financial ratings or try even better to not go out of business. And the way that carriers can try to combat losing their financial ratings or going out of business is they can drastically increase the rates, and or they can get rid of a lot of the risk by mass non-renewing their current clients, or they can really restrict the amount of business that they're taking on from a new perspective. And some of the carriers are doing one, two, or all three of those things right now. And the mass non-renewals, many of my clients, over 600 of them in the last year, have just been canceled by the insurance company, right? Major increases in rates, we're all feeling it. About a 30% increase year over year for the last 3 years. This has been happening. And then the restricting of new business, very few carriers are offering new homeowners insurance right now. And it's really interesting to see the landscape because there's just not a whole lot that's out there. Not a whole lot of carriers that are able to write right now.
Yeah. So you jumped to one of my questions. So, can people get insurance? Because I've heard a lot of people talking about along the Gulf Coast, 1 or 2 counties in, they're having a lot of trouble. So can you write insurance right now in Harris, Montgomery County, Houston area?
You can still get insurance in Tier 1, which is the counties just adjacent to the Gulf, and in Tier 2. It's very difficult, but you can get it. Now, the worse your profile looks, meaning the worse your claims history looks, and the worse your credit profile looks, the harder it is for you to get insurance. So there's been a lot of situations, and this has never happened in 2002, by the way, where we have clients that got canceled by their insurance carrier, whether it was just a mass non-renewal or they had claims, and they go and try to find insurance. And if their claims profile looks really bad, they may be uninsurable. And so we've had several situations where we just can't place the client. And that's never happened before in my career. We could always find a place for them. And so the message there is just don't file claims if you don't have to. And so I get the mindset, hey, I've been paying for insurance for years. I just wanted to file this fender bender of a claim, or my ice machine leaked and I wanted to file a claim just to get some money out of it. But that doesn't fare well for you when you go to the renewal time and or to shop new insurance.
Yeah.
You may not be able to get it.
Yeah. So we're going to talk about mitigation here in a minute. Yeah. So you're saying today on average, because I know I saw it in mine, we're seeing some people with 50% increase, 100% increase. What would you say? I think you said 30 is what your average?
30% since 2022 really has been the average, right? Okay. So 2022, 23, 24, now 25. And we were actually hoping 25 would come, the rates will pull back a little bit. And we are seeing a little bit. And I think right now it's probably more like 20% versus 30%. That, we haven't had a full year yet, but so it'll be interesting to see. But yeah, you'll get 50 to 70% increases on homeowners insurance, but then you might get a little bit of decrease on your auto insurance. And so in aggregate, the average that we're seeing for an entire account is about 30% still. Wow. Just crazy.
That's hard to fathom that over multiple years too, to see those increases.
And just to give you some background on rate increases. So when we were exclusive nationwide agents, Nationwide Insurance knew exactly when a client would leave because of a rate increase. And that number, and they knew when they would leave, and they would call us when we leave versus, hey, they're just leaving because they're so mad the rate increase is so high. And that number was about 8.1 to 8.2%. So a high single digit number, right? They knew at 8.2%, say, the clients weren't even going to call me because they were so mad. So what they would always try to do is get it right at 8% or 8.1 if they could, just so the clients would at least call and say, hey, I got this rate increase. Now, unapologetically, the carriers are raising at 30% because they have to survive,
Mm.
right? So it's just a crazy environment, right?
And all that's regulated, right? So the state insurance commission has to approve that
Yeah.
increase, right?
They have to approve, and they have to approve, and some carriers need more than a 30% increase to stay in business, to maintain their financial ratings. And so and they don't get approved for more than the maximum amount. Let's say it's 30%, right?
Mhm.
Say a carrier really needs to go in overall average of about 50 to 60 or 70, and they get declined by the state of Texas. So they have the option of, hey, let's just let this thing ride to go out of business or lose our financial ratings, or let's convert our market to be not regulated and go unregulated or non-admitted or excess and surplus lines. So there's this big trend of carriers moving to the excess and surplus lines markets where they don't have to be regulated. They can increase rates as much as they want to increase just to stay relevant.
Okay.
Right. So there's this big push and big trend of carriers moving to non-admitted status.
Is that what you're recommending for some people? Or?
Absolutely not. No.
Okay.
If you can
Just
get
checking.
you get an admitted policy,
Okay.
then
Just
you
checking.
should, yeah, you should definitely get a standard admitted carrier, and because there is some protection from the state of Texas if you buy from an admitted carrier versus a non-admitted carrier.
Okay.
Yeah.
So when people get these 30 and 40 and 50% increases, what do you recommend they do to maybe reduce some of that premium or to mitigate the risk? Because people need the coverage, but maybe the deductible was 5,000, they can raise it to 10 or 15 or 20, the wind and hail. What are you recommending to mitigate some of that risk?
Yeah, that's a great question, because the knee-jerk reaction is for people, I'm just going to shop this. I'm going to leave my current situation and go somewhere else. And I think
I tried to, but you won't let me leave.
Yeah, because you're in a really good situation, but if your insurance broker has you in a good situation with a good carrier, and the worst thing that happened was that your rate increased 30%, just like everybody else's, where are you going to go? Because the next insurance carrier, they just raised all the other premiums 30%. There's just really nowhere to go. So the best thing for me, the best advice, if you're with a good carrier and you trust your broker, put you with a good carrier, is to look at your deductible levels, and have them quote several layers above what you have right now, and just do the math.
Mm-hmm.
If the savings, say you filed a claim today and your extra out-of-pocket cost is $10,000 extra on your homeowners insurance policy, right?
Yep.
If you filed a claim and increased your deductibles by $10,000, well, the average homeowner, just is kind of anecdotal, but just say that the average homeowner has one claim in a 20-year period of time. Well, if you file the claim today, is it going to take you 5 years to recover in savings, 10 years to recover? If it's 5 to 10 years, really, if it's under 10 years, it's a no-brainer to increase your deductible, right?
Yep.
But if you're pushing the number up to 20 years as a payback, then you've got to, maybe it's not worth it,
Yeah.
right? But look at your home deductibles and look at your auto deductibles. Everybody that I see that's coming to me right now still have $500 deductibles.
Oh, wow.
If they bump them to $2,500, sometimes they can save $3,000 to $4,000 to $5,000. I mean, so auto claims, we have a claim once every 5 years or so, and so if your savings rate is under a year, that's a no-brainer to do that. If it's under 2 years, really 3 years, it's a no-brainer.
Just push the deductible.
Push the deductible and take it out, but make sure your broker has you with a good insurance carrier.
Yeah.
Right. If you're with a bad insurance carrier, shop it. See what you can do to get better coverage, a better financially rated carrier, and a better service carrier, and see if you can improve the situation also from a cost perspective.
Yeah, I think that's great advice.
Yeah.
Super advice. So I know some of the carriers you've dealt with, Chubb and Pure, maybe more specifically, came back into Houston, was it last year, and required certain repairs and things to be done in order. So we'll renew, but you've got to do A, B, C. You want to maybe share a little bit about that?
Oh yeah. So Pure's been around since like 2006. But last year, in an effort to mitigate losses, they identified some critical things that you could do to your house to save your headache from filing a claim, but to save millions and millions of dollars off of Pure's bottom line also by not filing the claims. And so they came in and they inspected every single home that they insured since 2008 when they started in Texas. They haven't inspected it. They inspected it and they gave a list of recommendations or requirements if you wanted to stay with Pure, right? And some of the top requirements: replace water heaters that are older than the warranty date, right?
Mm-hmm.
Really, if it was older than 10 years, they were canceling you unless you replaced your water heater. That happened to me, right? They would look in the attic and see whether your air conditioner pan had a float switch on it. If you didn't, it was a requirement, right? They looked at your the lines of the that go into your toilet, the plumbing lines that go into your toilet and washing machine. If they weren't stainless steel and metal on both sides, they were canceling you unless you replaced it.
Wow.
So they did all of this stuff to me, right? And your roof, if your roof was older than 20 years, they were making you replace your roof. And if your house was a certain size, it was say I forget what it was, but I think it was 5,000 square feet or bigger. They required that you put this automatic water shutoff valve that detects leaks. And if it detected a leak and told you, hey, are you home? Do you know that what's going on? And if you didn't respond, it shuts your water off. Or if there was a catastrophic break and it knows, all of a sudden there's 50 gallons per minute coming out, they would shut it down automatically for you. Right. So they were doing all of these things and telling you to repair these things. And if you didn't repair it, they would cancel you. And so people were upset. But if you think about what they did, I mean, and if all carriers did this, we'd be in better shape. But if you think about what they did, they really saved their members a ton of headache if they actually have a claim, right? Because people don't realize that the best time or the most often time when the toilet pipe breaks is when they're on vacation.
Yeah.
And so,
Oh, yeah.
so it's one of the number one causes of full losses to homes is that the plumbing line that goes into your house and it's made out of plastic. It cracks. And
While you're gone.
While you're gone. It always cracks while you're gone. Never when you're home.
I first heard that story, I thought, man, how can they make somebody do that? But then the flip side is, what does that do for protecting you going forward if you've preventatively fixed water heaters, done a roof? I mean, it does put your house in a much better situation.
Oh, yeah. And they're already seeing the numbers because if you look at the rates, Pure is still the most competitive private client carrier that's out there. And I think that spread as the years go on and as these mitigation efforts continue to work, that spread, the difference in their premium versus their competitors' premiums are going to continue to get greater.
Yeah.
Yeah.
Well, and I think part of it, our perspective at Waterway is that, we don't view insurance as something well, if I had a little ding, I want to make sure I get all my money back from all my premiums. Right? That's what a lot of people kind of use it as a offset. And at the end of the day, we view it as a risk mitigation and something that if you had catastrophic loss, it's not if a tree falls down on your garage. At the end of the day, you can fix that.
Yeah.
But we in 21 we had a water leak during that storm and flooded the whole downstairs, and I think the total claim was about $150,000. And so that was one where I think our deductible was maybe 2%, and we were with Chubb at that time, and Chubb waived the deductible, which I'd never even knew that was part of our policy.
Oh yeah,
and that was such a different. I wasn't thinking about the 150,000. I was thinking, man, I'm gonna have to spend that money for the deductible. That really's terrible. And here Chubb came back and said, nope, we waived that deductible, which I find that's pretty rare. But on some of the carriers you represent, is that pretty standard on the higher end carriers?
So for what we call private client carriers, the carriers that specialize in the multi-million-dollar homes, all of them have the deductible waiver. So for large non-wind losses, so if it's non-wind, non-hail related, if the loss is over, and Chubb is at $50,000, if it's over $50,000, they waive the deductible. But the other carriers have moved to $100,000 is the definition of a large non-wind loss. So at $100,000, they waive the deductible. So as long as your deductible is under a certain threshold, and each carrier has a different threshold, but yeah, they'll waive that deductible, which is one of the beauties of using the private client carriers when you can.
I was shocked.
Yeah,
I was pleasantly surprised.
Yeah, but your situation was big. I mean, 150 grand. That's when you file a claim. You know, that's catastrophic for most. I'm surprised it's catastrophic for you, but it's catastrophic for most of us.
Yeah, absolutely. All right, let's pivot outside Texas real quick, because we have clients all over the country. And I would say the two markets, I'm going to say California, West Coast, anything really from Colorado, Utah, anything with fire danger to the west. We'll talk about that. And then maybe Florida. So you can take whichever one you want to tackle first, because Florida is another unique situation. We've had a lot of people non-renewed there. So what are you seeing in those two regions?
Yeah, so two of the toughest regions in the nation, but it's also two of the most kind of the different environments in the nation. Whereas Florida, you have the regulations that are favoring private carriers stay in business in Florida, so it's generally easier still to get coverage in Florida, but the catastrophic events are not that they're not that dissimilar, right? So California, you have heavily regulated governmental action, and you have a situation where just about every carrier has just said we're out of here, right? And so Florida generally easier to get insurance. California almost impossible, especially if you want wildfire. Most of the carriers that are still there are excluding wildfire or giving you like a 50% deductible for wildfire. And so if your home is insured for $1 million, they will cover the wildfire, but you're going to take the first $500,000, which is just insane.
That's hard to believe. So what if you have a mortgage on that property? What will the mortgage company require?
Yeah, they basically won't insure you. They won't lend the money to you. And so we're working on a deal right now. It's actually a $20 million house. And the $20 million house has it's only gotten one offer from AIG on it, and the AIG offer was it's 50% deductible on wildfire. and guess what the premium is on it? It's $20 million with a 50% wildfire deductible.
200,000.
$369,000.
Wow.
And so we've only gotten one offer on it so far, and so we're trying to get a couple of other offers, but most people they can't afford that. Yeah. I mean, I guess if you live in a $20 million house, you should just kind of think it's going to be a little high, but not that high. But they're looking at 50% wildfire, but most people in California, they lean on the government to provide them wildfire coverage.
Okay.
And so the government will provide you can buy a policy for up to $3 million worth of wildfire coverage, but it only covers wildfire. So you have to go supplement everything else.
So is that like the federal flood, or is it state?
It's a state policy. It's
interesting.
They worked through Citizens Insurance Company, but it's a state funded and state subsidized policy. And when the wildfires hit, and the way that it works is that they'll collect premiums, and they'll put premiums in a coffer, and when a wildfire hits, they'll use the coffer to pay the claims. But like I think the day after the wildfire hits, they were out of money, and then they assess the private carriers that are still selling in the market their fair share of their. So if State Farm has 40% of the market share and it's $1 billion claim, they get $400 million of the claim that they have to write the check for.
Unbelievable.
Yeah. And so all those premiums just go, they just get assessed back to the client, the carriers anyway. I mean, I'm sorry, to the clients anyway. So the clients end up paying for that. The citizens end up paying for that regardless. Right. So. Wow. So yeah, interesting environment in California. Very, very difficult to insure in the state of California right now.
Yeah.
It's difficult in Florida, but just not as difficult.
Not as regulated.
Yeah.
The rest of the West, Montana, Colorado, Utah, you seen any issues there?
Yeah. So same issues. That everybody's scared to death of the wildfire, but the difference with Colorado, Utah versus California there are still carriers available, and it's not near as difficult to insure in those areas as it is in California. So that, as you know, my in-laws have that place in Durango, Colorado. Very few carriers wanted to insure it, but I was getting offer letters. Mm-hmm. Then we made a phone call into State Farm, and State Farm at a 30% of the rate of everybody else in like 5 minutes said, yeah, we'll insure this house. No problem. Boom.
Interesting.
Yeah. So
they kind of come and go in the markets as they want to take on risk or reduce risk.
Yes, they come and go.
So the stay with us forever is no longer a part of the industry. Get your discounts, longevity discounts.
Yes.
All right, let's switch. I want to pivot over to auto and umbrella, and then some jewelry kind of questions. So, what are you seeing right now on the auto side? You mentioned earlier maybe things are getting a little better.
Yeah, they're getting a little better on the auto side, which it's interesting though because the autos aren't immune to wildfires. The autos aren't immune to flood. And by the way, when your home floods, rising water that comes from outside in, homeowners insurance doesn't cover that. Auto insurance covers if your
Car.
cars flood. So, and right when all these cell phones started coming out, we started getting a lot of increases because of the distracted driving thing. But I think people have figured out how to drive and text all at the same time. Either that or the rate has already adjusted for that. But we're not seeing as drastic of increases on the auto side as we are seeing on the home side. So, actually, it's a little opposite. That sometimes the carriers are going down on the auto insurance, and that is almost the saving grace as to why the average is only 30% versus 40 or 50%. Yeah, but what we are seeing is an increased trend of these nuclear verdicts against umbrella policies, particularly in the private client area. So you have a wealthy family that's worth $20 million and they have a $20 million umbrella to match their net worth. All right. Then they have a kid maybe that has affluenza and goes out, gets drunk, gets high, and goes and jumps in the Ferrari and kills somebody. What's an immediate $20 million payout? Right. And so, but because of the losses on the bigger claims, it's more and more difficult to get umbrella insurance.
Yeah.
And the first 10 million of coverage is pretty linear. So like say it's $150 to $200 per million to buy an umbrella under 10 million. But when you get to the 11th million, it gets exponential. And so in that math factors in because there's other stuff that's going on underlying that is affecting those larger claims. And so the umbrella insurance is a little difficult to get right now. So if somebody comes in, it's new to the agency, new to the carrier, and wants a 20 to 50, or anything over a $10 million umbrella, there's a lot of scrutiny that happens because and a lot of times they'll say, let's start them at 10 million. We'll bump them to 15 next year, 20, and they'll stair step them until they can get used to the risk. Right. So
well, that was one of my next questions was we've had several people declined on the umbrella side, which I've never seen that.
Yeah, that's
rare.
It's all new, and it has everything to do with what they're calling nuclear verdicts from these people that and it may be fair. Somebody goes and kills your spouse or whatever, and you're looking for restitution for that. It may be fair, but it doesn't play real well for the profitability of the carriers and the ability to purchase the higher limits of insurance. And I wouldn't get their feelings hurt that they got declined. Everybody's getting declined right now without more experience with the newer carrier.
Okay, that's helpful. What about one question we often get is people want to transfer risk. So they say, let's put this car in my daughter's name and let her be on the insurance. What's the pro and con for doing that? I've heard that a lot, but I don't know that plays out well.
Yeah. So the biggest con to putting your youthful drivers or your kids on their own policy is it typically costs a lot more to do that. Right. That's the biggest con. But for more affluent people that can afford it, it is the pros kind of outweigh the cons because when you put a youthful driver, especially on their own policy, buy them their own car, get them their own policy, their sins don't affect your client and the current situation and insurability of yourself.
Yeah.
So if I had a youthful daughter or youthful son, that especially if they're kind of irresponsible, it's so much better to put them on their own policy because they go have a couple of accidents, they actually hurt somebody. It doesn't cross over to the parent's policy.
Okay.
And it especially in this environment where they're looking at every single claim, whether it's a windshield claim or a large bodily injury claim, it could affect your insurability if your youthful driver is not real responsible.
So sometimes it might make sense, even though they may pay 2 or 3 times what they're.
Yes, sometimes it makes sense, and I think you'll know when it makes sense.
Okay. Yeah.
You'll know that and we all have the kid at home that you just know they're going to be more accident prone than the other kids, and
Yep.
so maybe put that kid on and and hedge a little bit with the other kids, or put them all on
So
their
your
own
dad should have
policy.
put you on your own
Yes, for sure.
policy.
I had 3 accidents before I was 18. You know, I for sure should have been my own. And I saw the stress in his eyes when our insurance policy. And then our oldest daughter, she had 3 accidents before the 3rd week of her turning 16. And
Yeah.
so, but then she's been like super good from a knock on wood driving perspective ever since. So,
Mhm.
yeah,
That's
yeah.
funny. All right, last question for you.
Last one already?
Yeah. So I've been easy at hitting softballs here. So jewelry, art, collectibles, things like guns. Do you recommend separate policy? Do you put them with the homeowners? How do you decide what to do with that?
Yeah,
Art, collect, all that type of
So
stuff.
and this is a great question. So I personally, not professionally, I personally don't like to insure things that aren't going to bankrupt me. And if I don't insure it and I lose it, I'm just going to be a little upset, but I don't have to go replace those items, right?
Yeah.
And so if you're like me, you can choose to insure it or not to insure it. And to me, I insure a little bit of stuff just to maximize my discounts, but I don't worry about it that much. And if I ever lost the stuff, I probably wouldn't even file a claim on it. But those that are worried about it and they would be more upset if they didn't have it, the best way to insure your collectibles is on a personal articles policy, or otherwise known as a collections policy,
Separate from the homeowners.
separate from the
Okay, that's
homeowners,
good to
right?
know.
And so it's better to be separate from the homeowners, because those collectibles, if there's a loss, there's no deductible. The policy is broader, meaning it covers more things. So say you have $100,000 Steinway in your house floods, and you don't add that to your collections policy. It's just on your homeowner's insurance policy, right? So your house is flooded.
Mhm.
There's no coverage on your homeowner's insurance policy for the flooding of
Oh,
your
that's true.
house.
That's true.
But if you put it on a personal articles policy, it does cover flood,
Okay.
right? It covers. It's the most broad policy that you can buy from a personal insurance perspective, and it covers your items worldwide. And the beauty is you don't pay a deductible, right? And there's different ways that you can insure those things. Like handguns, if you're with the private client carriers, one of the Pure, Chubb, Cincinnati, Berkeley One, Vault, AIG, they all allow you to add these things on a blanket perspective. So saying I have $100,000 worth of guns, I just want to do a blanket policy, blanket coverage for $100,000, and my most expensive gun is $10,000. And they can do that for wine. They can do that for fine arts. They can do that for musical instruments, sporting, for any collectible that you have, jewelry. And so then you don't have to spend all this time going and get appraisals, listing and it disclosing to the whole world what you have in your house. You can just blanket cover everything, right?
Yep.
Middle markets, the carriers like Nationwide, Traveler, State Farm, they do require an appraisal for just about every item that you add, and they do require that you schedule for the most part, right? But yeah, if you really care about that stuff, I would definitely put it on a personal articles policy or a collections policy, however the carrier calls that.
That's helpful. So
Yeah.
I just thought of another one as you were talking there. Do you inventory everything in your house? You know, I've heard people saying you should inventory stuff. Some people say you should take your phone around and videotape what's in the house. Like, what do you believe as far as inventory? How hard are companies to deal with? Because I'm sure some will want make and model of everything from stove to the refrigerator to the TV. If you have a fire, I'm thinking catastrophic wipe out of the house.
Yeah, so every carrier has kind of different standards on that. And I've always for years told people the best way to do it is to videotape. If you open up every drawer and try to get all the underwear and socks in the drawers even, because you're gonna forget about those items. but I would take pictures of everything. I don't know if I'd go to the detail of putting year, make, and model and serial numbers of your appliances. But I would definitely take pictures or take a video, upload the video to Dropbox or put the thumb drive in your safe deposit box in case you ever need it. Now I've told people that for years. I started telling people that when we used to have like the videotapes, you have to take them out and stick those. But now you can put everything in the cloud. But I've told everybody that for years. And have I done it? I've not done it. Right. So private client carriers are much more lenient. They basically will just write you a check. Right. And so middle market carriers, they're going to make you prove that you owned all of the stuff. Yeah. And so depending on the situation, it's very conservative to tell people to go ahead and document what they have and as good of a documentation as you can provide. But I think a videotape of all your drawers and everything in your house is sufficient.
Yeah. That's good. All right. Anything else I'm not asking that I should be asking you? Well, can insurance agents change my rate? Can they help me get a better deal? I've been looking for one for a long time.
They sure can, but they probably would go to jail after they did that. So yes, but no. I wouldn't be able to change your rate without changing coverage or without.
I had to ask. Okay.
Yeah.
I need a discount.
So I was actually at dinner last night, sitting at the bar with Wendy, my wife, and an old client sat next to me, and he kind of asked me the same thing. What can we do these days, and should we be shopping every year? And so the question is, should I shop my insurance every year? And my answer to him wholeheartedly, and kind of also because when he was a client of ours, he made me shop his insurance every single year. and ironically, he's shopped it so much, he's just getting non-renewed right now. So he's looking for a new home, and so he's going to have some issues. But anyway, the answer to the question is absolutely not. I mean, and right now especially, it is the worst time to move carriers. You might be able to save a little bit. You might lose coverage, and people really don't understand their insurance and why they're getting a cheaper or less expensive policy. Most of the time, if they're getting a less expensive policy, because it's missing something that you don't already have. Mm-hmm. And so I would just caution people right now, listen to their professional broker that they purchased it from, and listen to their advice on whether it's time to leave or not. And if you don't trust your insurance broker, you better go find somebody that you can trust. Yep. Because this is the time to really lean on that person, right? Yeah. And just trust them. And I know it's tough. Times are tough. It's tough to make the 30% increases, but there's not very many places that you can go right now. So just buyer beware.
I think that's great advice.
Yeah.
Leash, thanks for your time today.
Oh, thanks. Enjoyed it. Thanks for letting me come on and talk in the box here. It's been fun.
Yeah. Well, hope to do it again soon.
Yep. Thank you so much.
Thank you.